Friends, welcome back. I am genuinely glad you are here today because what we are going to talk about in the next few minutes is not something you will hear on mainstream financial news, not in the way it deserves to be heard. And that is exactly why this channel exists. That is exactly why you are here. Because somewhere inside you, you already sense it. You feel that something big is shifting. The numbers are moving in ways that make powerful people uncomfortable, and the stories being told to calm you down are getting thinner and thinner. Today, we're going to peel that back together. So get comfortable, because we have a lot of ground to cover, and every single piece of it matters. Let me start with something that happened this week that honestly shook things up more than most people realize. The United States Supreme Court, in a 6-3 vote, blocked the emergency tariff powers that had been activated under a 1977 economic emergency law. What this means in plain language is that the executive branch was told, clearly and firmly, that it cannot unilaterally impose tariffs on the entire world without congressional approval. Now, at first glance, some of you might be thinking, okay, so the tariffs are gone. That is good news. Trade gets easier, markets relax. But hold on, because the real story here is far more complicated and, frankly, far more dangerous than that surface reading suggests. Here is what nobody is telling you. While those tariffs were in place, the United States government had already collected somewhere in the range of $150 billion in customs duties. 150 billion. And now, the question sitting on the table is, what happens to that money? Who paid it? Was it the foreign exporter? Was it the American importer? Was it ultimately passed down to the consumer standing in the supermarket aisle? These are not rhetorical questions. These are real financial and legal landmines that Washington has to deal with right now. Today, with no clear answer prepared, and then within hours of the Supreme Court decision, the response came back fast and loud. New tariffs, a different legal mechanism, a flat 15% applied broadly, not country by country, but as a sweeping measure, going into effect almost immediately with a duration of 150 days. So, the question the financial world is now wrestling with is this: did anything actually change? Or did we just swap one set of trade pressures for another while the underlying tensions continue building at full speed? Now here I want to stop and ask you something directly, because I want to know what you think. Do you believe these tariff changes are genuinely going to help global trade recover? Or do you think we're just watching one door close and another one open? Drop your answer in the comments right now. I read everything, and this debate matters. Back to the numbers, because that is where reality lives. When we look at the actual trade balance data for the United States, what we see is not a story of tariff success. The goods trade deficit last year reached approximately $1,241 billion. Compare that to the previous year at roughly $1,215 billion. So after all the noise, after all the economic nationalism rhetoric, after all the market disruption, the needle barely moved. The deficit actually grew. And yes, part of that is explained by American companies front-loading their imports ahead of expected tariff increases. They were buying more before the prices went up. Smart move, individually, catastrophic in aggregate for the numbers. But here is the twist that should concern every person watching this, whether you live in the United States, in Europe, in Asia, or anywhere else: China. Because while American pressure was supposed to contain Chinese export dominance, what actually happened is something completely different. Chinese exports to the United States did fall, about 25%, which sounds significant. But China's total trade surplus for the past year hit an all-time record, $1,194 billion in surplus. We have never seen a number like that from China, ever, in recorded history of their modern economy. How is that possible if American tariffs were working? The answer is painfully simple. China redirected its exports. The countries that had no significant tariff barriers in place, primarily Europe, absorbed a massive wave of Chinese goods. Chinese exports to Europe increased by 15% in a single year. 15%. And right now, as you're watching this, there are politicians in Paris, in Brussels, in Berlin, telling their citizens that trade is flowing, that the economy is managing, that the situation is under control. Meanwhile, the bilateral trade deficit between France and China alone sits at 50.2 billion euros. That's not a trade relationship. That is a one-way valve, draining the economic energy of an entire country. And this brings me to the broader picture that I find genuinely alarming. When tariffs are removed or weakened, when the only real counterweight to Chinese export flooding disappears, who fills that vacuum? Nobody. The goods keep flowing. The surplus keeps building. And countries that refuse to protect their domestic industries keep watching their manufacturing base erode quietly, year after year, while the official statistics are massaged into something more presentable. Let me be completely honest with you here. I'm not saying tariffs are a perfect solution. They are not. They create their own distortions, their own costs, their own winners and losers. But the removal of any serious trade pressure right now, given the structural undervaluation of the Chinese yuan, given that the actual equilibrium exchange rate for the yuan against the dollar is roughly 3.5, while it is currently trading around 6.90, meaning it is roughly half what it should be at fair value. This is not a technicality. This is a permanent competitive advantage built into the architecture of the global trading system, and it is not going away because a court issued an opinion. Now, I want to shift gears completely, because while all of this geopolitical and trade drama has been unfolding, two assets have been doing very different things, and the contrast between them tells you something important about where we actually are in this economic cycle. I'm talking about gold and Bitcoin. Let us start with gold, because the story here is extraordinary if you step back and look at the full picture. Just 2 years ago, in early 2024, gold was trading around $1,992 per ounce. Then came a move that even experienced market watchers described as aggressive. By January 2025, we were at 2,650. By April 2025, we touched 3,400. Then the acceleration really kicked in. By October, we hit 4,356, and in January of this year, gold briefly crossed $5,000 per ounce. $5,000. Think about what that number means. In historical context, we're talking about a metal that human beings have trusted as a store of value for 6,000 years. And it is now repricing at a speed we have never seen outside of wartime or hyperinflationary collapse. Yes, there was a pullback. We came back to around 4,663 before recovering. And as of this week, we are holding close to $5,180. The key point is this: gold did not collapse after its correction. It bounced, it held, it continued, because the forces driving it are not speculative momentum. They are structural. Central banks are buying gold at rates not seen in decades. China is one of the largest buyers. And here is something worth understanding. China is not buying gold because it is trendy. China is buying gold because it is actively working toward a long-term strategy of reducing dollar dependency. The yuan has actually been appreciating recently, which is itself a signal worth paying attention to. When the world's largest exporter starts allowing its currency to strengthen, it means something is changing at the foundation of the global monetary architecture, and gold is how they are preparing for that transition. On top of geopolitical buying, you have genuine fear in the market, ongoing conflict in Ukraine, tensions around Iran, uncertainty about the trajectory of American policy after court battles over executive power, inflation that has come down but has not disappeared. All of this creates a persistent demand for an asset that has no counterparty risk, no issuer that can default, no algorithm that can be hacked. Gold does not care about politics. It just reflects the level of fear and uncertainty in the system. Right now, that level is very high. Now, I want to ask you a second question before we get to Bitcoin, because your perspective here is important. Do you currently hold any physical gold, gold ETFs, or gold-related investments? Or are you watching from the sidelines? Tell me in the comments. I am genuinely curious about what this community is doing in real life, not just what the financial media says people should be doing. Bitcoin is a completely different conversation. And I want to be precise here because there is a lot of noise and a lot of emotion attached to this asset in both directions. The people who believe in it, absolutely, and the people who dismiss it, absolutely. The truth, as always, sits somewhere more complicated. Here is where we stand. Bitcoin recently was trading around $63,000, having fallen nearly 49% from its peak in early October. At moments during recent sessions, it dipped close to $60,000, which is a psychologically and technically significant level. Because if you look at the historical chart with clear eyes, you will notice something interesting. Around $62,000 to $63,000, Bitcoin has repeatedly found either resistance or support at different points in its history. This was a ceiling in April 2021. It was a zone of high activity in 2022. It was a trading range again in early 2024. This level matters. The concern right now is straightforward. If Bitcoin breaks decisively below $60,000 and cannot reclaim it quickly, the technical picture opens up the possibility of much lower levels. We have seen this before. In 2022 and 2023, Bitcoin spent months trading between $15,000 and $25,000 after previously touching $69,000. That is not ancient history. That was 3 years ago. Anyone who bought near the top in that cycle knows exactly what that feels like. And the current situation has additional complexity layered on top of standard market volatility. There are significant questions about liquidity flows in the crypto market, about the degree of leverage in the system, about the concentration of holdings, about regulatory uncertainty in multiple jurisdictions. None of these are reasons to make a definitive call, but they're all reasons to treat the asset with extreme caution, especially if you're considering entering at current levels simply because it is down from its high. Here is a thought experiment I want you to sit with. If something falls 49%, how much does it need to rise just to get back to where it started? The answer is not 49%, it is 96%. That is almost a doubling from current levels just to break even. This is not pessimism. This is arithmetic, and it is something every investor needs to understand before making decisions based on the narrative that a big drop always means a buying opportunity. I am not saying Bitcoin is going to zero. I am not saying it has no future. What I'm saying is that volatility cuts in both directions, and the same speed that took it to the top can take it much further down than most people are emotionally or financially prepared for. The people who are comfortable with that roller coaster, who have position sizes they can genuinely afford to lose entirely without it destroying their financial life, those people can make their own informed choices. Everyone else needs to be very careful. Now compare that volatility profile to gold's behavior over the same period. Since early 2024, gold is up approximately 154%. Bitcoin over that same period is up roughly 48%, and Bitcoin got there with swings so violent they would have triggered panic selling in the vast majority of retail investors before they ever captured the gain. Gold moved more slowly, more steadily, with corrections that looked scary in the moment but resolved quickly. The difference in these two journeys matters as much as the destination. And this is the deeper point. Gold has a track record of thousands of years. It has survived empires, currencies, wars, technological revolutions, and every form of financial engineering humans have ever invented. Bitcoin has existed since 2009. It has survived approximately one presidential administration cycle and two major market collapses. That does not make it worthless, but it does mean that calling it a safe haven in the same breath as gold requires a level of intellectual honesty that the crypto community sometimes struggles with. Now, let us zoom out and look at the full picture, because all of these pieces connect. You have the United States in a genuine constitutional battle over executive power and trade policy, with no clear resolution on the horizon. You have France and much of Southern Europe showing economic indicators that are quietly catastrophic, with unemployment projections heading toward 9% and business confidence at its lowest in over a decade. You have China with record trade surpluses, redirecting its export machine toward markets that have no defenses. You have gold repricing the cost of uncertainty in real time. And you have cryptocurrency markets showing exactly what speculative assets do when global confidence starts to crack. The people who are comfortable will tell you everything is fine. The data says otherwise, and the interesting thing about data is that it does not have a political agenda. It does not need to win an election or maintain approval ratings. It just describes what is happening, and what is happening right now across multiple economies, across multiple asset classes, across multiple geopolitical fault lines, is that the comfortable assumptions of the last decade are being challenged one by one. Before I wrap up, I want to ask you something completely different, because I always love knowing who is in this community. Where are you watching this from right now? Drop your city or your country in the comments. Whether you're in New York, Paris, London, somewhere in Asia, Africa, South America, it does not matter. I want to see this map light up, because this channel exists in every corner of the world, and that still moves me every single time. Let me leave you with a thought about what all of this means practically. The question for the rest of 2026 is not which single asset will perform best in isolation. The question is, which assets will hold their value when multiple crises converge simultaneously? Trade disruption, political instability, currency pressure, debt concerns. In that environment, the historical answer has always pointed toward real assets with deep markets, long track records, and no dependence on any single government's solvency. Gold fits that description more completely than anything else being discussed right now. That does not mean other assets cannot perform. It means that when you are building a position in something, you need to be honest with yourself about what category it belongs to. Is it a speculative bet on momentum? Is it a hedge against systemic risk? Is it a long-term store of value? Different tools for different jobs. The mistake most retail investors make is using a speculative instrument while believing they are protected. This world is changing faster than the official narratives can keep up with. The Supreme Court decision, the tariff pivots, the gold records, the Bitcoin volatility, the Chinese trade surplus, the French employment collapse, none of these are isolated events. They're all part of the same story. A story about a global economic order that spent decades being built on assumptions that are now cracking under the weight of reality. I tell you all of this not to create fear, but to create clarity. Fear is what happens when reality catches you by surprise. Clarity is what happens when you face the data honestly, make decisions with eyes open, and refuse to be lulled into comfort by people whose job it is to keep you calm. You deserve clarity. That is why this channel exists. That is why you keep coming back. And that is why, no matter how much pressure there is to soften these messages, we will not stop. Thank you for being here. Take care of yourselves. Take care of the people around you. Make smart decisions. And I will see you in the next one.